welcome to ET Now Startup Central, India's first and only daily show focused on startups and entrepreneurship. I'm Chandra Srikanth coming to you live from India's startup capital, Bangalore, and we have a power-packed show lined up for you.
And I'm Krishna Kumar coming to you live from ET Now's Mumbai studios. First up, I check on all that's making headlines here at ET Now Startup Central. Venture capital firms may be sitting on huge capital, but they seem to be extremely reluctant in deploying it just yet. Data from Venture Intelligence shows that Series A, which is the first round of VC investments in a startup, is at a 6-year low. However, seed investments have been robust. Arvind Ltd unveils its omni-channel platform Now.com, a non-discount driven e-commerce marketplace. Now will connect digital shoppers to every piece of merchandise from Arvind's warehouses. An exclusive chat with Kulin Lalbhai, the younger son of textile tycoon Sanjay Lalbhai, who will head Now.com. Info Edge posts a better than expected quarter of earnings while Zomato losses continue to rise. Info Edge paints an optimistic picture. A chat with the company's CFO coming up. Just a week after Ola signed an MOU with Bengaluru International Airport, Uber has now followed suit by doing the same. But it has gone a step further and upped the ante by slashing airport fares to 8 rupees per kilometer for all its categories, including SUVs and sedans.
Straight to our top story then, Krishna, where we are talking about why venture capital firms have been so reluctant in deploying the money that they've raised, because data from Venture Intelligence shows that Series A investments, which is basically the first round of VC investments in a startup, that is at a 6-year low. But at the same time, something that will come as a positive is the fact that seed investments have picked up during the same period. To put this all in perspective and give us a better idea of this analysis, we're joined by two special guests on the show today, Arun Natrajan from Venture Intelligence, as well as Sunil, Goyal, an angel investor himself from YourNest Angel Fund. Thank you so much, both of you, for joining us. Arun, first, you take us through the data that you've crunched and why this is both interesting and important.
Correct. So as we were going into the data for 2016 early stage investments, we found from the perspective of, let's say the entrepreneurs seeking to raise this kind of capital, both good news and bad news. Just to kick off with the bad news, like you said, Series A investments have, at least compared to 2015, come crashing down. So we used to see a median of at least 20 investments per month in 2015, which has come down to as low as 11 investments per month in 2016. This is the Series A investments. So if you are an entrepreneur who has raised some kind of seed capital from an angel investor or a seed fund and are now looking to raise upwards of $2 million, the situation doesn't look very rosy at this point. But we also looked into the fundraising data and to see if there is any clue in terms of why the slowdown in Series A investments. There we found that, whether it is some of the most active Series A investors in the past few years, whether it is names like IDG Ventures, Kalari Capital, Sequoia, Nexus Ventures, they've all raised new funds. So clearly the answer for, the slowdown in Series A is not in the money availability in the system. All of these funds who do Series A investments have enough dry powder with them. So now kind of looking at the good news for entrepreneurs, the specialist seed funds, like YourNest Angel Fund, Bloom Ventures, India Quotient, they have been maintaining a brisk pace of investments that they had set in 2015, at least 13 investments a month. They are carrying on with that pace even in 2016. So that's clearly good news for the entrepreneurs who are looking at seed capital.
All right, Chandra, I'm going to bring in Sunil Goyal at this point of time. Sunil, this is Krishna coming to you from ET Now's Mumbai studios. Tell me, at a time when regular venture capital funds are slowing down in doing Series A deals, what exactly is encouraging seed funds to keep up their pace?
You see, this is the period when the valuations have become realistic. It is the time when the quality of entrepreneurs has continuously improving. See, when an exuberance period ends, the party ends, it doesn't mean that the quality of entrepreneurs and the quality of ideas die out. It is only about that availability of money is restricted to higher quality entrepreneurs. And that is what we are finding is that now the pre-series A or seed investors like YourNest, Bloom, India Quotient, etc. are able to find attractive valuations, and hence we are continuously looking at newer sectors, newer avenues from the emerging sectors like IoT, cloud, virtualization to SaaS platforms, etc. and some unique consumer businesses as well. So that's the reason we are continuously investing in the Series A, pre-Series A stage.
Right, encouraging words coming in there from Sunil. But Arun, give us, broader perspective of, the precedence here. Are we staring at what, a 5 or 6 year low? And also, in terms of the number of deals, how is it different from previous years?
Sure. So, if you take a month like, let's say, March of 2015, we saw as many as 20 Series A deals and something like 7 seed deals only. Now if you compare that to March 2016, the number of seed deals are at 10, which is higher than the comparable month, but the number of Series A investments has come down to 7. So clearly the lines are crossing vis-a-vis seed and Series A. But if you take the historic average kind of thing, especially if you take the median number across the years, 2015 was clearly an aberration. If you take that out, this number of 11 Series A investments is not too bad. So 2014 we saw was around 14 in terms of the average Series A investments per month. So historically compared to 2014 and 15, this number is low, but overall before that, this number of 11 Series A is not too bad.
Right, Sunil, based on your conversations with Series A investors, what is the reason for them slowing down? And also, is this pace of seed investments sustainable, given that your portfolio companies will come up for Series A rounds in 6 to 12 months' time from now?
See, after a period of exuberance, there is always a hangover period that is going to be there. So there is some mild slowdown. That doesn't mean that the money is not available with the Series A guys. Our purpose of investing in pre-Series A or a seed round is to ensure that we build such high quality companies that the kind of traction and the kind of stability between growth and profitability and sustainability that the Series A guy is going to be looking forward to, we're able to build those kind of companies and identify those kind of companies, and definitely they'll come back. To give an example, last year same time we had 7 companies in our portfolio, and 5 of them saw an up round in the last 12 months, and some of them after the party was over. So that kind of conviction that we have is that once you build a right company, money will flow in, maybe a little later.
Arun, is there a question that you want to ask Sunil, considering both of us are joining us here? Is there anything that you want to ask him in terms of the pattern that you're seeing here?
Yeah, so you have set a very brisk pace for this year, as many as 5 investments. So this is clearly the highest number of investments you have done in a year, right, in terms of the pace.
Oh yes, let me just classify the last 4 years of YourNest. The 2012 was a stability period. 2013 to mid of 14 was a period when liquidity was tight and was a tight period. Then was a 1 year of exuberance, and then the softening started. In this softening period is when we started making investments. During that particular 1 year of exuberance, we were only doing follow-on investments in our companies, or looking at some B2B businesses that were coming with the right teams and the right valuations to us, and they were in such a unique space that we had a time to build them and get them ready for the Series A now. So it is just because there was a pause of our investing in you can say 2014 second half to 2015 first half. So that particular deal flow is what you are seeing being reported now in the last 7-8 months, and These are the companies which are even in the consumer space, not only in the enterprise space, from artificial intelligence like Arya, from B2B e-commerce like AHA stores, to consumer companies like SmartQ and Fashion Lots, which we believe can sustain for 12 to 18 months or even 24 months with our capital of $500,000, and hence by the time the good market scenarios come by, they're ready for Series A and B rounds.
All right, Sunil, finally, before we wrap things up, tell us, some investors are asking startups to be frugal in spending and also go for multiple seed rounds before getting to Series A. Is that a good thing or a bad thing? Because it could hamper investments needed for growth.
Being frugal in the initial days of a startup helps them build a lasting organization. The character of an organization, a culture of an organization is built around that. Yes, having money through multiple rounds of seed rounds or pre-series A rounds, etc., is a tough task for them in the initial period, that they have to be continuously in the market to raise money. But people like us, we keep enough money. Any angel investor has to keep enough money for the follow-on rounds for their existing companies. We do that. We have, in a first fund of 90 crores, we've invested, we've kept 30 crores for follow-on rounds. So follow-on rounds prior to Series A or along with Series A is what we need to be keeping enough cushion. So it is about discovering and rediscovering your business with these these multiple rounds, and then hit the market with bigger customer base, better customer traction, and raise confident money from Series A guys.
Thank you so much, Arun and Sunil, for really sharing perspective on such an important issue. I guess, Krishna, the verdict here for startups is that they don't have to worry. Series A may have dried up, but seed funds are very active. Seed investors are very active, but I guess they have to be extremely careful about using cash, because the quantum is clearly coming down. The 15 million, 10 million Series A that we saw last year, definitely not happening.
Oh, absolutely. And that seed funding is the silver lining amongst the dark clouds surrounding the funding tap as far as startups are concerned. Away from that and on to the big launch of the day, Chandra, Arvind Limited's omni-channel platform now.com, that's NNNOW.com, a non-discount driven e-commerce marketplace. It comes under Arvind Internet Limited, established in 2013, which is a hybrid startup of tech and fashion, made in India with its headquarters in Bengaluru and a creative division here in Mumbai. Now will connect digital shoppers to every piece of merchandise from Arvind's warehouses, 50-odd brands, and a network of more than 1,200 stores across 200 cities. And Harvard alumnus Kulin Lalbhai, who is the younger son of textile tycoon Sanjay Lalbhai, will head now.com. We caught up with Kulin. Take a look.
Now.com is India's first true omni-channel portal in the fashion space. Now, what is omni-channel? Omni-channel is about linking the online and offline journeys, the shopping journeys, and bringing both of them, the best of both of them together. So what do you get with omni-channel? You'll get a host of first of their kind features. Let me give you a few examples. If you're sitting in Mumbai in BKC and you order an Arrow shirt, the Arrow store from somewhere close by, maybe Bandra, will deliver it to you in as less as 4 to 6 hours. So this is the first of its kind, because all the inventory all across the country is live.
But Kulin, omni-channel is a term that's been bandied about by a lot of traditional retailers, be it Future Group or Shopper Stop. So what is so different about now.com that you're doing, that you're calling it omni-channel? You say it is different from the way omni-channel exists at this point in time.
See, I think omni-channel is often confused with multi-channel retailing. What multi-channel means is you sell online and you sell offline. Omni-channel is saying that you integrate the two, and that when you integrate the two, magic happens. Like I give you an example of same-day delivery, right? There is nobody who can offer you same-day delivery in India today. Today, if you go to now.com, if you're in Bangalore, Delhi, and soon we'll be rolling it out in major cities, you order an Arrow, you can put in your PIN code and we'll be able to tell you whether we can deliver it to you in 4 hours. Similarly, you don't like the product. Instead of having to fill out those forms and wait for a guy to come and pick it up, just go to a neighborhood store, hand it over, and no questions asked. You exchange it, pick up something else that you love. In the future, stores will not just be sales mediums. They will be experience zones. And with omni-channel, we will bring in all these digital experiences to the stores. So if you walk into a small store of ours in a tier 2 city, you will have this beautiful screen, which is an endless aisle. And you will get the entire Arrow offering there. So in addition to the 10 suits that are in the store, you will get another 150 which you can order, which could be in another store somewhere else in the country.
Talk about Arvind's, omni-channel commerce, which includes e-commerce play as well. Now, what's the kind of investments that you're looking to make in this, and what's kind of returns that you expect? More importantly, are you safe on margins?
So that's a great question. So the first thing I'd like to say is we are not a .com. Okay. We are much more than a .com. And, for us, GMV has no relevance. Okay. For Arvind, we are going to be one of the largest portfolios in the fashion space. So we are looking at $1 billion business by 2018-19 in the offline space. And I think every well-executed omni-channel model can achieve anywhere between 10 to 15% of the overall revenues over time. We are not just resellers. We are brand originators. So our entire margins per se are very different from just being a reseller. The second aspect of what makes an omni-channel model very unique is that the entire logistics cost involved is very different. Because you are not flying products around from one part of the country to another part of the country. A lot of fulfillment is hyper-localized, so the costs associated are very different.
Away from that to Info Edge, which reported its earnings today, better than expected numbers, Krishna, but of course all the attention was on Zomato, particularly after their recent valuation markdown. Let's hear out Info Edge CFO talking about Zomato's performance this quarter.
Zomato has doubled its revenue, so obviously that's good news. So far as we are concerned, obviously we own just close to 40-50% of that, so our console will ultimately reflect only the net effect of that, and yes, losses have gone up, but I think that's the reason because we have done the geographical expansion, the expansion of line of business, and also there are certain exceptional items, like we had certain kind of accelerated amortization of some of the Urban Spoon acquisition, the goodwill that we had in the Urban Spoon acquisition. So all that has contributed to losses as well. But even there, if you look at between first half of the year versus the second half of the year, in fact, the second half, and particularly the Q4 for Zomato seems to be very good. Almost like 1/3 of their overall revenue has come in quarter 4. While their actual cash burn is less than 15%. So if you look at the run rate from Zomato perspective, I think we are very encouraged to see where they are. Of course, I think there is a lot of expenses that happen in H1, but we are happy that H2 has been far more moderated.
On to the other big story that we're tracking over here, Chandra. Just a week after Ola signed an MOU with Bengaluru International Airport, Uber has now followed suit by doing the same. But it has gone a step further and upped the ante by slashing airport fares to 8 rupees per kilometer for all its categories, including SUVs and sedans. Uber will now get a designated parking spot at the airport premises and will reduce waiting time for commuters. The new fare is certain to trigger another price war as both cab aggregators try hard to lure travelers at one of the most busy airports in the country. Back to you, Chandra.
With that, we come to the final segment of the day, Number Crunch. The number we are crunching for you today is 109. That's the number of countries, Krishna, where WhatsApp is the top messaging app. This is according to SimilarWeb. Lot of countries clearly using WhatsApp, and now WhatsApp is not just something that you use with friends. It's just invaded our life space, be it bosses, be it colleagues, be it anyone. Everybody is just communicating through WhatsApp. But I guess one country where WhatsApp is not dominant, I'm sure, is China. Because there they have their WeChat, which is extremely popular. But I guess WhatsApp still managing to hold out compared to competition by a mile.
And of course, we here at 18 Hours Startup Central also communicate with each other on our own WhatsApp group, which is 18 Hours Startup Central. So that number is only just natural that we happen to mention it here on the show. But with that, we do wrap things up here on this edition of 18 Hours Startup Central. Thank you so much for watching. But keep watching 18 Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.